Major funding for these programs is made possible by grants from Chase Commercial Term Lending, New York Community Bank, Capital One Bank, Perfect Building Maintenance, M&T Bank, Customers Bank, Genova Burns, Terra CRG, Meridian Capital Group, Wyckoff Organization. Additional support is made possible by AKA Hotels Corman Communities, Aerial Property Advisors, AmTrust Title, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Fisher Brothers, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Hersha Hospitality, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, The Continuum Company, The Moynihan Group, and these friends.
So is the world coming to an end in Europe? Now that everybody doesn't know, I got to leave the United Kingdom. Where do I go? Where do I put my money? Where is the place to be? Is it New York City? Is it America? I don't know the answer. So I've assembled this group of 4 prestigious individuals to provide their insight on where they see the world today in light of Brexit. My guests include Peter Darcy, who is the president for the New York City and Long Island region and also the head of commercial real estate lending for M&T Bank. The eminent economist, my buddy, Dr. Sam Chandon, who is the dean of the NYU Schack Real Estate Institute and the principal at Chandon Economics. From Kansas City, Missouri. Kansas City, Missouri, or Kansas?
Either way.
Okay, either way. Dan
State
Flanagan.
line runs right
Okay,
down.
Dan Flanagan, who is the department chair for real estate and finance for Polsinelli. Okay.
Polsinelli.
And last but not least, I'm not sure where you're from, but I know you live in Connecticut.
Flushing,
today.
New York.
Flushing, New York, originally. The Harbert family over there, my friend Joseph Harbert, who is the president for the Eastern region for Colliers International. So you're really the guy on office. You're the guy on all different aspects of financing. We don't know what you do for a living, but we're trying. And you have a mix. You have financing, you have real estate clients. So on a national perspective, how do you see the effects that took place in June on the market today?
I did try to poll both our developer clients and the lending people, and basically the best I can do is a slight positive to U.S. real estate generally, including out there in the boondocks, where I come from originally. I mean,
they have buildings over 6 floors.
A few, yeah, and covered wagons get through there, pretty well. But we've already seen some uptick in actual foreign investment back in the Midwest, and to the extent that there's more foreign investment into places like New York and San Francisco, then I think we'll see some ripple effects back there. LA, just in the first quarter of the year, went ahead of London as the second most active commercial real estate sales market in the world. So things aren't all confined to New York and San Francisco.
As somebody would say, we're in the early innings. We're in like inning 1. because it's, just a couple weeks ago. How do you see the fifth inning, Dr. Sam?
Well, with regard to Brexit specifically, I think there is certainly this immediate uncertainty around how it is that we might negotiate an orderly exit. There's a lot of speculation around the potential dissolution of the United Kingdom itself, if Scotland were to try and go its own way. That's creating a lot of confusion. But in the medium term, I think what we see is that this doesn't resolve itself very quickly. An exit would not occur until 2019. There is a period of significant negotiation during which, for many businesses in the UK, uncertainty means holding off on new hiring, investment in factories, and expanding the productive capacity of the UK economy. All of that, I think, means a weaker economic outlook for Europe for the foreseeable future that will accrue to the United States and to New York and other major markets in particular, where global investors seeking capital preservation, safe harbors, London is simply no longer on that list. The benefit of that over time accrues to New York City.
Since you're a Canadian, how do you see the effect on the Canadian market?
The Canadian market, I think, is a challenging one. I think we've seen over the last couple of years that they've had to weather lower energy prices. That's certainly impacted currencies in as much as the Canadian dollar is effectively a petrocurrency. The next couple of years, I think, are going to be particularly challenging for Canada.
But how do you see the effect on Canada now? Will people be making an investment? Because I recently read an article saying that Vancouver, people are continuing to be very positive about Vancouver. But that, I remember when Hong Kong split off a couple of years ago, Vancouver also hit a market over there.
Yeah, I think that what you see is that the Canadian market for commercial assets is still rather small. And it's very easy to saturate that market if a large number of institutional investors were to come in, which in part is why we see institutional investors from Canada being so active in the United States. There's a critical mass of properties here. With regard to investment into the residential market, and I think Vancouver is an example of this, where from Asia Pac we've had a significant number of dollars come in for a significant period of time, but also in Toronto. The greatest challenge I think the Canadian economy will have to weather over the next couple of years is that they are in what I think is fair to call a housing bubble, and one that has been encouraged by policy, one that has captured a disproportionate share of consumer activity and investment, and prices are set to come down. That will be very difficult for Canadian consumers.
Okay. Peter, since you handle specifically the New York City and Long Island regions, but you handle also the national real estate perspective for M&T, which is predominantly on the East Coast, how do you see all this?
Yeah, I think that I agree with Sam's point that uncertainty is going to drive investors who have to allocate dollars to real estate on the margins more to the U.S. and gateway cities like New York. And it was really New York and London were the real flight to quality cities. Now, if you have a choice, it's New York more so than obviously London. I think that we'll have lower interest rates for longer because of this. And I think in total, there are going to be some things that the U.S. and New York will get a short-term bounce from, but overall, I think it's a negative. In general, I think it's going to be good for high-end luxury apartments in New York, which have really been slowed down tremendously, so I think it's good there. I think it's a negative for hotels and hospitality.
You think it's really good for the high end?
I think that's been struggling, and I don't think it's doing well, and I think there's way too much expensive inventory. But to what degree somebody, an international buyer, and all of that's been driven by international capital flows, I think they're more likely to park money in the U.S. where the dollar is going to be appreciating, not because it's some great investment, because they have to pick a place to put the money. They're more likely to do it here than they were pre-Brexit.
You have clients, some major developers who are building luxury. How do you feel? Do you think it's going to help their sales?
Just a little bit. And to me, it's interesting. The rental market, the high-end luxury rental market gets lost in the talk about high-end condos. But there's a real problem in that market that I don't think is going to get helped at all.
You see a problem in the market?
Yeah, I think rents have slowed down, and I think it's kind of plateaued there.
I think the expiration of 421A, which is where most of the high-end luxury housing has been built, everyone raced, and there was a bubble of inventory that's going to get delivered in the next 18 months. So there's a short-term headwind that's going to be tough to absorb, but I think it's a pretty stable, well underpinned long-term market, but I think the next year or two, there's going to be a lot more concessions and there'll be some softness, not a lot of
Especially if they can't build without 421A for
Right.
a while.
But that will help long-term. The
That's
fact
what
that
I
there is
meant,
no
yeah.
421A,
Right.
this stuff in 2-3 years will.
Yeah, the cranes are the greatest enemy.
So the big question is, you specialize in the office market, okay? You have a 5-state, 6-state region.
Boston to Key West. There you
Okay,
go.
boss, it's even more than that. So how do you see the market? Okay, we have the Big Apple over here, where people are, as Sam was saying earlier in the show, people are looking at these boutique locations like Dumbo Heights, and maybe Williamsburg and other markets over there in downtown Brooklyn. How do you see the markets today, being affected by what's happening in Europe, what's happening with lower interest rates, and in general because there are a lot of opportunities, even though we have a third situation, when you go to downtown Manhattan, there's a lot of new office buildings being built up, and you have the Hudson Yards, and you have also on the west side,
And you have development in Brooklyn.
and you have development in Brooklyn and so
Queens.
on, in Queens.
But demand is strong. The U.S. economy is doing fine. Sam might disagree. But the New York economy is doing very well. And leasing activity is up year over year 15%. Property sales are at $13.7 billion for the first half of the year. 40% of that is foreign, some foreign money involved with that. It's still a great place to invest and a great place to be. My longer term worry is about business confidence. Consumer confidence may be longer term as well, but business confidence. What happens when business people say, how am I affected by this? Is that everybody pauses for a second or two and they start to make their decisions based upon their own predictions about what the future is going to look like. And I think there's a worry that this could be a contagious situation where the European economy shrinks a bit, and then it could, and I'll defer to Sam on this, but I think it could longer term impact us here in the U.S. in terms of a recession.
When we're looking at asset classes, Peter brought up hospitality, and I brought up hospitality and retail. Retail has been down in general. If you look at the number of the shrinkage of stores, and what's happening with the retail community in general, besides the bricks and mortar effect of that, retail, a lot of the retail business in the tri-state area has been created by European people coming here to buy their purchases, and also the hotels. So we have a confluence of more hotels being built in the suburbs, lower dollars, not as much buying power. How do you see all that with regard to hospitality and to retail? And I'd like that open to the general comments.
I think,
Especially
yeah.
since you're the only guy who's lending money.
Yeah,
We're just sitting here as cautious observers.
Retail is an asset class. Our whole business has grown substantially. It's the one area where our exposure actually down over the past 4 or 5 years, and it's really because of the issues you've said. I think we're at a point where the internet growth has been about 15% a year, but it's becoming the entire world is shifting much faster than people, I think, are recognizing. And as an asset class, I think a lot of the rents, at least in New York City in the high end, got pushed up way too high. And there are people with high bases in these assets, and they're not budging on rents, and vacancies are picking up dramatically. Soho's 20% vacant. Madison Avenue is very soft. So I think it got way ahead of itself at the same time that the retailers started to have an epiphany that the world is changing on them. And at this point, we're due for a correction in retail, and we're I would say, extremely cautious in what people are projecting and thinking, especially regarding any growth, let alone maybe declines.
And I think there's also a mixed perception of retail, like you brought up Soho, where the world is slowing down, and Madison Avenue. People don't realize, I was with somebody who's owned a property in the meatpacking district 70 years ago. He said if you walk down the meatpacking district today, most of the retailers aren't doing well. Okay, they're really hurting over there. They may be busy at night for drinks or dinner, but you cannot, as Shelley Fireman has once said to me, you can't survive on one meal a day. It's just not that type of situation. So retail is hurting over there. And then, what do you think? And this is something that I don't think anybody's brought up. There's been a lot of hype about Staten Island with regard to the outlet center and to the wheel. And they've been advertising this a lot in Europe, hoping that they would get European visitors to come to Staten Island. Where do you see this effect? Any idea on that?
I think for the European consumer, the United States as a destination looks a little bit like a reach at this point, certainly more so than a year ago. And the possibility of a contraction in Europe will place them at a further disadvantage. So it's not just that commercial property looks more expensive for your average European consumer. I think a trip to the United States is more expensive. The thing that I think New York has benefited from significantly over the course of this recovery has been that we've had steadily improving and year-over-year record highs in visitors to the city from elsewhere, both domestic and international. That's coming under pressure, I think, because of a slowdown in China that's difficult for us to assess in terms of its depth and duration, but that has the possibility, the potential to slow visitor traffic from China. Certainly, conditions in Europe don't lend themselves to extended holidays in the United States or consumption here. The confluence of factors, I think, means that we've relied quite heavily on that growth in visitor traffic into New York City to drive some of our retail outcomes over the last couple of years.
Retail and hospitality.
There's an over-reliance on that, in particular on the retail side, in as much as when we look at sort of domestic and local consumption, which should be the bedrock, ultimately, of consumption activity from retailers, that doesn't look quite as strong. And it comes back to something that Peter's mentioned. When we look at growth in retail sales overall, whether it's New York or nationwide, they've grown at a reasonable pace. But that's been really reflective of significant growth in online sales. So when we turn our attention away from retail and look at something like fulfillment centers and industrial in and around New York City or other major metropolitan areas, you really begin to see just how much of the retail activity is shifting. Over the last several years, it is really dependent on your product type. If you're an electronic seller, a bookseller, then you're in real trouble. But some asset classes, some types of retail have been perceived to be fairly immune. Groceries are one example of this. But what I think we see is that there is real reason for concern in as much as some of those safe havens for retailing, where we thought that the bricks and mortar would be relatively immune from substitution into electronic commerce, they're coming under threat as well. And I think that requires that we really revisit some of our underwriting in the retail sector.
You bring up two other interesting points, which I really would probably like to address to Dan and to Joe. The industrial market has really been doing well. E-commerce has aided the industrial market quite a bit, okay, and distribution over there.
Absolutely.
You have the New Jersey
and Long Island. There's almost no industrial space to be had.
How do you see that on a national scale?
The same thing in the Midwest. We don't know. I don't know a lot about it, but I do know that it's in good shape. Industrial. On the other hand, retail, nothing happening in a while.
You're running Long Island also and national over there. How do you see the Long Island market? Do you believe maybe foreign investors are looking in Long Island?
No, it's not a.
You don't count Queens as part of Long Island?
Well, maybe. No, I don't. It is part of.
I know some of
the
the marketing
Some people do.
statistics.
It is on Long Island.
Yes, it is
But
on.
the housing market in Long Island is, from a rental standpoint, is very strong because you can't build there. So it's very hard to introduce new product. Vacancy is very low, and the stuff that's coming on is, I think, in very good shape. The industrial, I think this is playing out all over the place because of the trends to e-commerce that Sam mentioned. Industrial seems strong in all parts of our footprint. I think the big thing, for your audience to think about or understand is there's two things that happen here. We try and stay focused on what drives the fundamentals of the properties. That doesn't necessarily isn't the only thing going on, but the fundamentals, because of Brexit and the uncertainty, are probably negatively impacted by all of this. I don't see that much great stuff happening out there that's driving fundamentals. I do see a shift in capital flows and interest rates that keep pumping up values. So values might go up. It doesn't mean that long-term this is good for properties. It just means we're building more risk in for bubbles and excess asset prices driven by things that aren't really tied to the performance
Let's talk
of
about the
properties.
financing arena with regard to that. The balance sheet lenders, CMB lenders, insurance companies. How do you see all of this play out with the recent events? Joe, Dan, Sam?
Well, I think with the availability of financing, and lending activity in the market, I think it really comes back to Peter's point, where no individual lender in the market sets the terms. We have a competitive market, in some cases in multifamily, a very competitive market, and that means that we've got market pricing. You are either going to participate on the terms that the market sets, or you're not going to be a lender. And that creates, I think, a difficult situation, because individually, when we're having conversations with people in the market, they do describe concerns around exactly what Peter's describing, that we've got capital flowing into U.S. markets because the money's cheap, because of the safe haven issues, because of global instability, and that is inflating asset prices to the point where we can make a very credible case that we've got frothiness in this market. Continuation of lower interest rates, further pressure on global capital into New York only exacerbates that over a longer period of time. But when you look at the fundamental side of it, the underlying fundamentals are probably hurt by what's happening in Europe. And I think our biggest concern right now is that a recession in the UK, if it undermines confidence, has the potential to spill over. So you've got risk to the U.S. market, to U.S. real estate, in as much as this encourages, over time, a decoupling of prices from the underlying performance of the properties.
But so far, so good. I mean, I don't see anything on the horizon immediately that says that jobs are going to shrink in New York. We have more people employed here than we ever have had before. Sure, we may have a little bit fall off in tourism. There may be fall off in retail sales. But there are a lot of people who want to live in New York, and they shop in New York, and they shop for fundamental things in New York and not necessarily luxury high-end goods.
Let's talk about two states which we also, since we are in predominantly four states.
Forget about Connecticut and Jersey?
No, we are in Connecticut and New Jersey, and that's where where I really want to focus on, because Peter's very active. M&T has really built up a big New Jersey business. But we discussed before what's happening in Stamford, and then we also have the question of what's happening when GE moves out. How do you see those markets? Do you see foreign investors saying, this is maybe the great opportunity? I'll go to Connecticut. This is where the opportunity
Only
is.
if we trick them into it. No, I don't see that happening.
That's what they're going to think of London as. If the prices go down in London, that's going to be the opportunity.
Well, what about REITs? There was an article saying that REITs today, it may be a very worthwhile investment for European investors to invest in U.S. REITs. Any thought about that?
I read the article. I think
That's why I
anytime-
can't trust the press.
You could easily paint the other case that was very bullish on the fact that people are going to want to direct their money into these institutional REITs. I think that with interest rates this low and with the asset prices so high, if you're buying a REIT, you're essentially buying those future cash flows of those properties, and you have to look at it on a more long-term basis based on some normalization of interest rates. So I think real estate today is one of many, many places where it's difficult to have a really compelling investment thesis about the future. There's more risk in the future than there seems to be in upside. Things seem to be pretty pricey everywhere, whether it's the stocks,
Any less
whether
risk
it's
in the stock
bonds,
market?
whether it's there. And this is part of this really low interest rate environment, and it seems that the ability for for interest rate and monetary policy to influence and grow the economy has stalled out. That's really the problem and the concern. There doesn't seem to be that much inflation building into the system, and we've had this policy for a very long time, and now it's very unlikely they're going to be able to unwind it in the short term given the instability in Europe, because that would just be a drag on future growth. So we're kind of stuck in a catch-22.
Question: a lot of money has gone into private equity funds, and a lot of private equity funds and alternative lenders are your competitors. Okay, they're competitors at a higher price because they don't have the banking regulations. They have different ideas. Do you see more foreign investors from Europe or the United Kingdom and so on making investments in private equity funds?
I do, yeah. And I don't know what else to add to that, but it's an attractive place to be.
And how do you see the private equity funds and the alternative lenders today? Where are they going to sit with the changes in the world today with lending?
I think we've got, in parallel with all these other macroeconomic and global issues, significant changes in the regulatory environment for commercial real estate lending over the course of the last year, but certainly over the course of the next couple of years. A lot of attention is focused on risk retention, which would come into effect
I think it comes into effect on December 25th, the 5% risk retention, okay? So it's a Christmas present, okay?
Of sorts.
It's a combination Christmas and Hanukkah present, okay?
Yeah.
But what happens over there?
Well-
Now, I mean, the CMBS lenders, how do they look at this?
Well, there's this fear of uncertainty.
He's happy, now they have to
Yeah.
take risk.
Right.
They have to eat something up.
But I personally believe that it's a very creative market, and they're going to work through it. I mean, there are already clients of ours that are developing funds to invest on a 10-year basis into those deals, and there are investors out there and capital everywhere. So I really believe that it's not going to be a serious problem. It's going to be until it happens, and then it'll be worked through, I think.
And I think the issue that we face here is one where the competitive position of different classes of lenders in the market begins to change, in as much as we have increasing unevenness in the extent of regulation. So we've got changes for CMBS, we've got meaningful changes for banks. HVCRE is an example of this. But the competitive landscape and the position of these different sources of capital shifts. And one of the things that I think we're beginning to see as a result of that is exactly what you're describing. Non-bank financial institutions, alternative sources of capital, have become more competitive. From a regulatory perspective, I think this is actually quite problematic. The goal of regulation in the banking system has been to improve the overall quality of the balance sheet and reduce the possibility of deterioration during a period of economic stress. But what we're also seeing is that, at least for some institutions, they're better borrowers that can access alternative financing at competitive rates will decide to go there. And so in some cases, we've got some evidence that the average borrower quality for new originations at the bank are actually deteriorating a little bit. That's exactly the opposite of what the regulator
good. What do you say?
That's a really interesting point. I think I could think of some examples of that, but that doesn't jive with me in the big picture directionally.
And I'm not saying it's systematic.
Yes,
No,
but I think it's a really interesting question, and I think I see the risk a little differently. I see it that the risk, because it's become a much more prominent place of liquidity into this marketplace, and it's much more fickle capital. So I see, and the sources of funding are already getting a little dicey for them. So I see it more as more assets build up in the shadow banking system. When you have the eventual sharp pullback, you're going to leave a much bigger gap and that's going to create systemic risk, or that has created systemic risk. And I do think there have been some borrowers that have accessed it, but they haven't accessed it at competitive terms. They've really traded recourse and higher proceeds levels, and they paid up for it, as opposed to having a choice between a bank product and a shadow bank loan and deciding to go for shadow bank.
Okay. We can't accomplish everything in 26 and a half minutes, but I promise another thing. In September, the 16th season starts. I promise to bring back this entire crew and to reflect 3 months later on where we stand.
That'll be embarrassing, I'm sure.
Because then we'll compare A to B and we'll see if it's really true over here. But in general, I'd like to thank Peter, Dr. Sam, Dan, Dr. Joe, and I'll see you next week.
Thanks, Michael.
Thanks, Michael.